welcome to the first Tech Talk Tuesday of 2024. There is a lot ahead of us in the stock market to start out this year, and we are going to go ahead and cover it all from a technical perspective. It's Tuesday, January 2nd, 2024. My name is Karla, and with me today is your favorite CMT, David Blake. David, how are you doing this morning?
I'm doing well, and Happy New Year, Carla.
Thank you. Happy New Year to you as well and to all of our listeners. Let's go ahead and jump into it and take a look at last week's stock market activity and what's ahead.
Okay, well, 2023 wrapped up last Friday. Pretty stellar year for the market. I believe it was one of the best markets performance-wise for the NASDAQ since something like 2020 or 2003, something like that. So that was good. As far as the S&P 500 went, I think it was up around 16 or 16%, something like that. But anyway, investors were in a holiday spirit throughout the week until the last day. We still made up for a ninth consecutive week of gains. Now, that's the longest win streak for the S&P 500 since 2004. So that kind of lets you know how bullish this move has been. We did see yields tick lower during the period. That towards the end, they started to tick up a little bit more. They're ticking up today as we start kick off 2024. Haven't seen why they're doing it today, but we'll take a look at that. Maybe I'll write about it tonight. One of the things that we got last week was, we had a lot of investors still hoping from the week before when the FOMC meeting wrapped that, we're going to continue to see a few rate cuts. Now they're saying as early as March. I still think that might be a little early. I'm not on board with that yet, but we'll have to see. Now, as rates begin to move lower, that also weighs on the U.S. dollar, which hit a 5-month low last week, and intermarket analysis will tell you that, as the US dollar weakens, it's actually pretty good for equities. And one of the reasons is because the dollar goes in, the multinational and international companies don't have that currency exchange problem when they bring back their revenues from overseas. The yield on the 10-year Treasury closed on Friday at around 3.88%. And remember, that's down from 5%. So we've had a big move since October, which has fueled this market rally that we've had. We did see crude oil prices move a little lower during the week. They're up again today, and they were up Friday. I don't expect to see that oil prices really go down.
Okay, that seems like a pretty solid start to the week, minus the higher oil prices, of course. Which sectors of the market were the strongest and which ones were the weakest?
Okay, we did see the energy sector was the weak link in the market last week. It was down 1.34%. And as far as outperformance goes, it was basically the rate sensitive and defensive sectors that people were buying as the last week of the year, and that's happening today too. Even though we're down today, which we were talking about for the last week or two, consumer staples, utilities, healthcare, and REITs have been the where people are going as rates stay low or go lower. Some of these defensive and rate sensitive sectors and stocks will be the ones that will outperform. They start to look a little bit better. Kind of if you read the weekly market letter last week, we talked about the dogs of the Dow, which we can talk about a little bit later. But anyway, we had the Dow Jones make a new high last week, and the NASDAQ 100. Investors were kind of hoping we'd see the S&P 500 bring a new high, but came up a little bit short. And then on Friday, of course, started to roll over. We did get some selling on as people sold a little bit of the last day, so their trades would settle in the new year, and that would delay some tax consequences for that. So we ended the end of the year with a whimper, but we were able to celebrate on the week with the ninth week of gains, and that was certainly just keep on rolling in here after the year we had. It basically was made the whole year.
9 straight weeks of gains is definitely impressive, but how is the technical condition of the market doing?
Now, the technical condition of the market is positive, but as I noted and have been noting for the last couple of weeks, we are basically extremely overbought. The technical indicators are bullish but extended. By that, I mean they're at the top of the range where you don't want to see them. There's not much upside for some of these things. We have stochastics in the mid 90s. That was going into Friday. So we've had a little bit of a back off on that. And then we had the 14-day RSI was in the 70s. I think on one of the indexes, it was actually up to about 78, which I can't remember the last time it was on that, something like 2008. But when they're up in the 70s, you're usually gonna get a little bit of a pullback, and they're actually higher than we were at the July high. So that was something that is concerning. And then as we kind of went sideways a little bit towards the end, as we were overextended, we got the MACD, which is a short-term trend gauge, crossed into bearish ground, especially I think on the S&P 500 and the NASDAQ. I'm not sure about the Dow. I talked about when you get that overbought like that, generally you're going to have some kind of a little bit of a pullback. Whether today is the start of something, maybe like a 3 or 4 or 5%. We'll have to see. We're still in the Santa Claus rally for another day, so we'll see if maybe we get a little bit bounce tomorrow, but we'll have to see. Now, I did mention that if we do have a sell off over the next week or two, I'm looking for probably around 4,600 on the S&P 500. Carla, can we go to the charts real quick just to show something here?
Sure.
I did get a couple emails that somebody wanted, why did you pick 4,600? I put in SPY.
All right.
Okay, now as you can see over here in the middle of this chart, up in July, right around 4,600 is where the market topped out. Go that long red one there. Yeah, right around there. So you can see right 45.80, 45.90, 4,600. That's where S&P 500 topped out. And then leave it right there, but go over to the right. You can see there in at the beginning of December, end of November, the S&P 500 came up to that every 1, 2, 3, 4, 5, 6, 7, 8, 9. We had about 8 or 9 days where it kept coming up to that 4,600 to see if it was going to break through that resistance, and it finally did. And then we were able to rally on from there. So I would expect that to be a point where if we do get more selling as people, book some profits from this last 9 weeks, that would be where I would expect the averages to move down. Now the Dow chart and the NASDAQ chart looks just like that. We don't need to go to those, but for the Dow Jones, I would think we could probably see that come in around 36,250 would represent a nice area for you if you're wanting to get long into the market here or nibble at some stuff that you've been looking at. That would be an area for that. And for the NASDAQ, I think somewhere around 14.4. Now we're already down to 14.7 today on the NASDAQ. So that wasn't a bad call. I think that, like I say, we'll probably get a test of those levels. It's somewhere right around the 30-day, a little bit below on the NASDAQ, that's pretty much where July highs were also, right around that 14.4 area. So I would expect to see that. And if you look at the chart on NASDAQ, there's about 2 weeks here where the index was flopping around that 14.4. And that also is just a little bit below the 30-day. It's not quite down to the 50, but if it takes a couple days for this thing to get down to that 14.4, the way the 50-day moving average on the NASDAQ is moving up, we might get to that point. That would be where it ends up being support.
All right. And what about underlying breadth? How are we doing?
Okay, underlying breadth. We've talked about that was getting a little bit out of whack and almost becoming a contrarian indicator here. It's still bullish, but we didn't have big gains in the AD lines last week. The AD lines and the advanced decline lines, they're considered leading indicators of market direction. And we did see them, they've been moving up higher as we go along, which generally that will peak before the market does more of a sell-off. So I'm watching that to see if maybe this week if we go sideways a little bit of downward bias, if we start to see more of a pullback in the AD line, that would be something that I would watch for is hinting that we could get that 5% sell-off. 52-week highs outnumbered the new lows for a fourth consecutive week. That just shows a little bit more of the broadening out of the market rally.
Okay, and I know that the last few times that we talked, Investor Summit was also kind of getting out of whack. How is that doing right now?
Investor sentiment, there's not a bear out there right now. That's you don't want to be on the same side of the trade if everybody's on one side. The reason it's a contrarian indicator at this stage is because if everybody's long the market, who's left to buy? So it means that the market's kind of going sideways and everybody's all in, but there's not any money on the side there to come in. Although there is a lot of money in the money markets and stuff like that. But if you're one that's been holding, getting some treasuries or have some money market funds, I think I would wait till later on in January to maybe try to put some of that money to work. In fact, the hedge funds as of last week were up, had exposure to equities at 102.7. That's the highest exposure to equity since November 2021. What happened on that date? That's when the NASDAQ and the peak before we had the sell off where the Dow peaked in January. So that's something to watch. I would, when you get to these peaks like this, you don't want to ignore them. You can say, oh, everybody's pretty bullish. It's 60% or 65%. When they get up here around 90%, you want to take notice of that, and you kind of want to step back and maybe book some profits. You won't go broke taking a profit. And besides that, you don't want to wait till the market sometimes starts to go, because if it starts to pull back, people can start to sell pretty rapidly. They'll start getting scared, especially if they just started coming into the market in December. So, like I said, I've been saying that because we're so overbought by the technical indicators, and investor sentiment has reached, as Goldspan said, irrational exuberance. That's something that I'm just kind of sitting here. I booked some profits here today in some of my tech stocks. Not that I want to get out of them and go to the sidelines. I may look again as we come down to this 4,600 on the S&P 500, maybe a nibble away. I just think that the way our cycles and market timing models are, there's a good chance that we could see around the second week of January, third week of January. That is where some of our cycles, longer term cycles, begin to start to bottom. And if we're in sync here, and there's been some questions about that also, then I think that that would be a position where we could start to bottom then there, and then start to, as they reset, we could start to see some more bullish activity in the market. But I wouldn't be real anxious to buy the first pullback here in January if this is it, or if we get on for the next 2 or 3 days. I think I would give it a little bit more room just to see how things play out. You also want to see in the back of, they're not talking about it yet, but just be aware also that in January 19th, I believe, Congress gets back, I think, on the 9th of January. On the 19th, we have another government shutdown looming that we could cause some volatility in the market, and that could also, cause selling to pick up. They'll probably start talking about that over the next week to 10 days. But just be aware of that, because you know how we get to these, they kind of extend it to the deadline, and all of a sudden the market volatility starts to pick up. And if they ever do something, and with the government shut down or something like that, we could see more of a sell off. And you just want to be aware of that with all the bullish sentiment out there. If all of a sudden they decide something's not quite right, boom, because that would also cause rates to tick higher, which again would be bad for equity. So be aware of that, and that's kind of why I want to just I'm not afraid to sell anything in here right now into, while we've had these 9 weeks of gains. I'm not anxious to buy anything quite yet.
Okay, that actually brings a question to mind for me. Regarding the MarketEdge Sentiment Index hitting that all-time high, do you happen to know when the last few times historically this sentiment indicator has reached close to these levels?
I went back several years, and to tell you the truth, I could not find a -9. Now, I didn't go all the way back to 2000, where we had the dot-com blow off, or anything like that. We've gotten to -7 several times, but a -9, I don't. The only thing I can say is possibly back in 2000, when we had the big blow off and went into another bear market. It's just that right now, I think there's a lot of analysts out there and a lot of market participants that have never been in a rate cycle like this, where all of a sudden you start to ease, where rates start to move lower. Everything you read about it, all the books will say, "Oh boy, don't fight the Fed, and if they're going to ease rates, and you want to jump in." My only concern with that is that I'm not sure that we're going to see three three rate cuts, and I'm not so sure we're going to see March as the first rate cut. Several weeks ago, in one of my market weekly letters, we talked about back in the 80s, 70s, and 80s, when I forget his name now, was the Fed chief. they actually started to cut, and then they started to cut too early, and then as activity started to pick up again, inflation picked up again, then they had to take them all the way to the top again on the rates, and that caused a really bad market for, actually several years, and that's our Federal Reserve does not want that to happen again, and that would be bad for the market, and basically it would cause the market to just to flatten out and be stagnant for an extended period of time. So if you ever want to read about that, I have Sometimers disease. I don't know why I can't remember the name, but the Fed chief at that time, like I say, he started to cut aggressively too early, and then inflation reared its head again, and inflation started to pick up, and then they had to really move aggressively, moving rates higher again, and stocks just took on the chin. And so they want to make sure that that doesn't happen here.
Okay, well, fair enough. And also another thing that I wanted to ask you about, David, our market edge posture here on the home page and also our CTI, that's our intermediate term forecast. So I see that the CTI has dramatically dropped to a -6 to start the week. So, considering that, plus all the other overbought indicators that we've mentioned, what's keeping the market posture at a neutral configuration instead of turning to a bearish configuration?
Part of that is just the fact that, you don't want to fight. You don't want to just jump in front of a moving train. We've had a rally in here for 9 weeks. At the end of 3 or 4 weeks, when the CTI, those cycles started to turn to a negative thing, you're not going to jump in front of it and then you have the train run you over. You kind of wait for the train to slow. It's kind of like with momentum. When if you have a ball and you throw it up in the air, out of your hands, it's really moving. But as it gets up near the top, that speed of the height is really slowing down until it finally stops, and then you start coming down. So you just kinda wait until the momentum has slowed enough that you can say, "Okay, well, the CTI, the cycles are heading down now, and the momentum has pretty much run out of steam." There's a good chance that I could go to an avoid on the posture this Friday. We only change the posture and update the CTI on Fridays off the weekly chart. A lot of times I'm looking for negative divergence to hint that, we're close to a top. We haven't had that. That's a couple weeks ago, we had it on the weekly charts. I thought, "Okay, well, this is probably a sign that we're near the top," but then it corrected itself, and we had I think it was when, Powell said that that they're not gonna be raising rates anytime soon. Again, we'll probably be cutting. I think that was when the market went up 500 points or something that one day, and that pretty much supported any negative divergences that we had in the charts. So we kind of have to wait for that to happen again. It could very well happen this week because, like I say, the advanced decline lines have really slowed. I'm not sure. Last week we had, yeah, so last week on the advanced decline lines, even though the market was almost up 1% on the Dow, the NYSE advanced decline line only added 541 units, and normally up week you're going to be adding, 2, 3,000 like that. So I have to report as being positive, but I wasn't going, oh boy, this thing's really, going to town here. And I think the Nasdaq only had 500 units on also. So that's showing that there's very few stocks that are breaking out and hitting new highs and that type of stuff. And advancing, there's just as many going down as up last week, and that's something that we're going to look at. And we also want to look at this week if we do have a couple days updates after today. You want to see whether or not the AD lines are positive or negative, and so I wouldn't be surprised to see some negative. If that happens, then probably on Friday we would go to an avoid. Several of the cycles, as I mentioned, are getting ready to start to put in bottoms.
All right. Well, that's helpful to know. And also, I had one last question, David. You mentioned here in the letter that an investment idea actually, and it's called Dogs of the Dow, which is a cool name. You've also mentioned how it's beating the Dow Jones 8 out of the last 11 years. Can you go over what exactly that is?
Yeah, basically what you're doing, dogs of the Dow have been around for 50 years or probably longer than that. I'm sure. But what they do is you're taking the stocks that are out of favor, and you're hoping since they're in the Dow Jones, they're automatically good, healthy companies. They have a lot of revenues coming in. Hopefully they're making money. A lot of them have been raising their dividends, for 20 years, that type of thing. And even there's some strategists that even do this with mutual funds, is they take their best mutual funds and then they buy the mutual funds at the end of the year that are out of favor, figuring, okay, well, now that the ones that are out of favor should probably come back into style this coming year. So if you do that, especially if you're an older gentleman or woman, you can come in here and you're basically buying the top 10 highest paying dividend stocks that are in the Dow Jones. This year, I think if you buy them all, you're gonna be somewhere around 4, almost 5%, before 4 and 3/4, 5% dividends, and you're buying some pretty good looking companies. Now, there's a lot of people, this year, the list includes Walgreens, Verizon, 3M, Dow, IBM, Chevron, Amgen, Coca-Cola, Cisco, and Johnson& and Johnson. Now, as you could as we've been going here the last couple of weeks, healthcare sector has been one of the leaders, and of course, Amgen and Johnson have been some pretty good looking charts at this point. IBM has been kind of a laggard for God knows how many years, but now they're starting to break out into the AI field. You're getting a lot of press on that. It's coming up near 52-week highs. The Chevron could be another good play if this Red Sea and Mideast stuff starts to kind of get a little dicey. So you're buying again stuff that's been out of favor for a little bit, and most of these stocks were down in an up year for the market. So probably as things always come back to the norm, these stocks should begin to outperform. You have different strategies that people do. Some of them peel off, they readjust every quarterly. I don't think you should do that or do it every semi-annually either, because if you get something like a IBM or maybe a Cisco, where all of a sudden they do come into favor, you can have a double in the stock. Why get rid of it after a quarter or 6 months just because you're still gonna be getting that big dividend, but let them run, and then at the end of the year, that's when you decide to swap off. Some of the stocks are still in there, maybe you trim it back a little bit, but, you buy an equal weight of, all 10 stocks. You have $100,000, put $10,000 in each, just let the dividends pile up, and at the end of the year, you just roll it over with the next batch, and it's like I say, has beaten the market over and over and over several times. A year like 2022, a little bit tough when you have the Nasdaq up 40% or whatever the heck it was. So that's something that you might look at. It's an easy way to make your own ETF or mutual fund. You don't have any, rather than you can do it, but you do it yourself rather than have an ETF or mutual fund do it, and then you save yourself all the fees too that they are normally going to hit you. You buy a mutual fund like that, they're gonna take 3% of your money, or as part of the gains also, and the ETF's also gonna take a little bit of managing fees too. This way you can do it yourself and save a little bit of money. And again, these stocks have been out of favor, but they're historically, once they revert back to the norm, they very well could be the leaders in 2024.
All right. Well, that is very helpful information, David. We are actually running out of time this week, but is there anything that you would like to add quickly for the end of the week?
No, I think we're good. Remember the Santa Claus rally goes today, goes tomorrow. So, but I enjoy the gains you got right now. If you have something that's maybe a little bit, more in the techie field or really high growth or something like that, and you've got a heck of a profit over the last, say, 2 or 3 months, it wouldn't hurt you to peel back. I do think you're going to see a little bit of. You have some things on the horizon, like I said, that if the Fed starts to talk about, well, we may not be cutting in March, then maybe you have rates tick up a little bit. This government shutdown thing, they're going to be starting to talk about again in about a week or two. A couple of those things could cause the market to pull back. Just be careful in there right now. You should be loaded up and kind of just now think about, you know, coming back, and we'll see how these cycles go. And again, a good chance that things, if we get some negative diversion showing up this week, we could go to an avoid on the market posture, and in that case, we'd probably be, negative on it for a little while. So just keep that in mind, and we'll go from there.
All right. Well, that wraps up this week's MarketEdge Tech Talk Tuesday. David, thank you as always for all the great information, and you guys can catch us again next week.
You got it. All right, Karla. Bye bye.